These are heavy times. This is not a quote from the recent speech by the Netherlands King to our Parliament. It is a line from the 1980 song Won't You Hold My Hand Now by the UK rock star King. These are heavy times indeed, especially for multinational enterprises. The tax strategies of multinational enterprises have become the subject of a public debate. Aggressive tax planning, transparency, morality and fair share have become key words. The public hearings by the UK Public Accounts Committee, where a number of representatives of multinational enterprises were grilled by Margaret Hodge on their tax strategies, were quite fascinating to watch. Public discussion of the tax strategies of multinational enterprises is not something new. What is new, however, is the fact that a lot of parties have joined the debate. Especially so-called non-governmental organizations, such as Tax Justice Network, have claimed their place on the stage. Aggressive tax planning has become a hot topic, both for national governments and for international organizations, such as the EU and the OECD. In the Netherlands, the focus has been on the position of flow-through companies and the Netherlands ruling policy. The position of the Netherlands is that its current tax system is robust, transparent and fully compliant with all international standards. The Netherlands' position is also that it will embrace fundamental changes proposed by the EU and the OECD. The EU mainly focuses on situations of double non-taxation that may occur as a result of the use of hybrid entities or hybrid instruments. Typically, these types of entities or instruments result in a multiple deduction of the same expense, or a deduction of a payment which is not included in the taxable income of the recipient. The ambition of the OECD is more far-reaching and to a certain extent also covers the EU plans. In February of this year, the OECD released the Baps Report. BEPS is an acronym for Base Erosion and Profit Shifting. In the Baps Report, the OECD identified a number of key pressure areas that need attention in order to effectively prevent aggressive tax planning. The BEPS plan would result in changes, both in the legislation of the individual countries and in the tax treaties concluded between countries. This summer, the BEPS Action Plan was published. The Action Plan contains 15 action points that are designed to counter both the erosion of the tax base and the cross-border shifting of profits within a multinational group. These 15 action points can be broken up in 4 main categories. The first category is structural changes to the OECD Model Treaty. The second category is aggressive tax planning. The third category is transfer pricing. And the fourth category covers the remaining issues. Now let's take a closer look at the first category, structural changes to the OECD Model Treaty. The first item is to address the tax challenges of the digital economy. Basically, the issue is whether the fact that a company has a virtual but not a physical presence in a certain country should create a taxable presence in that country, both for corporate income tax purposes and for VAT purposes. The second item, preventing artificial avoidance of a permanent establishment status, has to do with the fact that currently, under most treaties, a company may conduct operations in another jurisdiction via an agent, where this does not lead to a taxable presence of that company in the foreign jurisdiction. A number of real-life examples popped up during the interrogations by Margaret Hodge. The second category is aggressive tax planning and abuse. Treaty provisions and domestic rules will be developed to neutralize the effects of hybrid mismatches. Rules and best practices preventing base erosion via interest deductions and other financial payments, such as captive insurance payments, will be developed. Controlled foreign corporation rules, which are aimed at taxing passive income held offshore, will be strengthened. The OECD also wants to tackle the use of tax treaties by third country residents, so-called treaty shopping. A number of anti-shopping rules are already in place. A well-known example is the limitation on benefits clause in a number of US tax treaties, the business purpose test in the Netherlands-China tax treaty, and the beneficial owner clause in the OECD Model Tax Treaty. The aim of the OECD is to restore source taxation in a number of cases, also by the imposition of substance requirements. The Netherlands Under-Minister of Finance has already indicated that substance in the Netherlands has been and will remain key in the Netherlands tax ruling policy, and that in the absence of sufficient substance, the relevant treaty party will be informed. An interesting item is the disclosure requirement, which ties in with the country-by-country reporting rules which in some jurisdictions already apply to certain types of industries and which have also been tabled by the EU. The question is whether this information should also become publicly available. This is something that, for instance, Tax Justice Network would like to see. The OECD, however, takes the position that detailed information on the amount of taxes paid to the states where the enterprise is active should only be made available to the relevant tax authorities and not to the general public. This is in line with the views of a number of important OECD members, such as the United States. The third category, transfer pricing, also contains a lot of items. The majority of the cases discussed by Margaret Hodge during the sessions of the UK Public Accounts Committee involved transfer pricing. The focus of the OECD will be on profit shifting by means of the allocation of intangibles, capital and risks among group members, as well as transactions that do not, or very rarely, occur between third parties, such as the charging of head office expenses. The two most interesting items of the fourth and final category concern the mutual agreement procedure and the initiative against harmful tax practices. The OECD wants to develop effective solutions for disputes between states, especially on transfer pricing issues. This could be beneficial for multinational enterprises. The initiative against harmful tax practices focuses on countries that use their tax system to compete against other countries. The interesting question is what effect this measure will have on states such as Luxembourg and Switzerland. The action plan contains an indication for the timing of the action points. Overall, the OECD expects that the action points should be completed between September 2014 and December 2015. Some people have called the BEPS Action Plan ambitious, whereas others have called the action plan naive. Irrespective of whether the plans are ambitious or naive, we at KPMG Meijberg & Co. believe that the BEPS Action Plan should cause multinational enterprises to rethink their tax strategies. Is your tax strategy flexible enough to be able to adjust quickly to the changing tax environment? Do you have hybrid structures within your group, and if so, can you unwind them without negative consequences? How is the transfer pricing policy within your group, including the policy on where to locate the group's intellectual property? Do you have a tax communication strategy? The hearings at the UK Public Accounts Committee have made it clear that communication on your tax strategy has become crucial. If you do not have a clear tax communication strategy, you may end up with a public relations nightmare. We at KPMG Meijberg & Co. have the people, the expertise and the experience to help you build a robust global tax policy which will help you deal with the future. When I was small, I heard Bob Dylan sing, "The times they are a-changing." Well, now that I'm old and grey, these new times have almost finally come to the world of international tax, the small world we all live in. Let's keep in touch, hold hands and make sure the heavy times go away. Thank you.